For many traders and investors like you and I out there, that move on the markets in the last 24 hours may have seemed bonkers. But in today's video, we explain why a melt up might have been the best thing actually for markets to do. We also need to talk about $200 billion being added on by only 7 companies, 50 of the top S&P 500 stocks having their best day of the year, the NASDAQ performing the best since April, and of course, government shutdown fears being taken away. What has this all led into? Well, it's a market that is ultra bullish at this stance, but are we approaching where the bears truly sit? Today, we talk about the liquidity traps that could be coming soon, the maximum pain of trillions of dollars of options expiration, and more importantly, why the stats are starting to point towards possible pullbacks over the next week. We'll also be discussing some of the big breakout stars. Tesla, over the last couple of sessions, we've been bullish on this. What a huge move, almost a gap fill. But the star of the show has to be the Russell 2000, a massive move across all small caps, leading into the biggest trade volume that we've seen in quite some time. And more importantly than that, we approach that simply amazing 180 to 181 resistance. So with trillions on the line, yields dropping off, and everything looking great, should now be the time we actually say, let's take another look at these markets and see what's going to happen next. Well, welcome back everyone to The Daily Show, where we talk about markets around the world. If you like macro, lead indicators, hottest charts, or anything to do with markets, make sure to subscribe and smash that like button. We do this every single day together. We've been going strong now for 3 years thanks to people like you. Let's take a look right now at what's happening. It was a sea of green across the board, but there were some interesting sectors. Utilities really performing amazingly because of the expectation now of yields going down. More on that soon, but let's have a look at the CPI number that did this. And it was just basically 0.1 less on the core, 0% across the board. And realistically, it was lowering and the markets just loved it. It doesn't really make sense for it to go up this much though, and for the fact that the market was so aggressive. It was more because it was squeezing so many bears out. And unfortunately, many bears out there would have been getting crushed over the last 24 hours. I'm sure that has happened to some of you out there, and it's really scary and obviously quite upsetting when you get put in those positions. This is probably the reason why I think a lot of this happened. Equity put call ratio was showing us that we had way too many puts in the system, and Wall Street certainly wanted to crush those positions, pushing it higher. We've seen similar occurrences to this, and we posted it over on our Twitter X account. So if you're interested in taking a look at all of those things, make sure to jump on over, and links in the description down below, along with our new newsletter for VIPs. Early access is in there, totally free. And of course, I suggest you go and sign up for that. It's in the same link. Let's have a look at bullish percent index. We saw a huge rise up in this. We're waiting to see whether it can get above 70 to really tell us we've probably got a new all-time high coming in. But for now, very strong movements. And it's kind of showing you that pullbacks are probably going to be met by bull demand, which I'm sure most of you are aware of considering these moves so far. This is where the stat comes in though, 7, 8, and 9 days. We've shared this one before quite a few times. Since 1950, when you had such huge rallies up, you might be thinking, wow, pullback's coming. Unfortunately, the stats were against that. The stats were actually ready for a melt up, and it wasn't really a melt up. It was more of an extreme parabolic move all the way to the next level, which is that 45-12 zone. And we'll talk more about that later on. Another reason that you may have guessed why this could occur had to do with the bull-bear positions in leverage retail opens. Basically, we had 61% of people bearish on leverage positions, 39% bullish. The FTSE was the only one with the bullish position. Guess what? Didn't do very well. And then, of course, the Dow was 70% bearish, 30% bullish, and it goes on and on and on. I posted this over on our X account as well if you're interested. So what's happening? Well, the Russell had the standout day. 5+%, that's huge. And of course, it's going into an interesting period for it because somewhere around this November into December, January period, we do tend to see a bottoming of Russell that usually comes in with a very nice gain through that January into February effect. This is the one that many people will start to talk about and start to focus on. And did we just see activation of the Russell for the next couple of months? It's very possible we did see that because we already know we had a great read on the 2000s cycling from the 52-week low. We shared this now, I think almost 2 weeks ago, maybe a week and a half ago, and it showed that over the next 1 month, all the way up to 12 months, the Russell was mostly sledged to outperform the S&P 500 at the NASDAQ, 25.6% average return with a 100% track record. And it wasn't like we had just a few data stats for this. We had quite a lot. Now, of course, that's a long time away. And for traders, they're going to say, wow, that's too far away for me. But it does show you that there's possibly a change here that's occurring underneath. We also posted some stuff on maximum pain over on our X account, which we'll go through soon. But let's discuss probably the biggest elephant in the room. You're probably saying, well, how could we be going so bullish when everybody turned bullish on sentiment surveys last week? Yeah, everyone turned bullish, but it seems like the reality is they weren't actually going bullish. They were buying puts. And that's a little bit of a concern. And that's why we actually managed to get up to these levels. 50% though bearish into 42.6% bullish. I'd be very interested to see how this week's data comes through. Will the sentiment report really show that? Here's one that really was timely for the last video, which was us talking about corporate insider sells on utilities dropping to the point where usually you expect a bit of a bounce. They had a plus 4%, which is a lot for utility sector over the last 24 hours. So obviously those insiders getting a little bit of a knowledge on what was maybe going to happen next. Before we go through some dark pool transactions that happen, some big ones, share of investors who say they're bullish about stock markets, just be concerned if this continues to hold up, because as we know, often when we do get these strong reads for a period of time, there is a pullback coming. And that's something we will be looking at on the channel together very, very soon. Here's another one that I thought was interesting, which was basically all of the investors piling into treasuries. And you might think, well, that's why I don't want to buy treasuries right now. Well, actually, when we reach these similar points, such as March 2009, November, and even other serious points where we've seen these over investment in treasuries actually haven't performed super badly after this. So it's something that we will be looking at. And of course, I'm actually expecting treasuries may have just bottomed based on the previous structure that we've seen in markets at this stage. We've been talking about that for a little while. We also know that bond yields usually anticipate a Fed cut coming, 2 months, 4 months, 3-month leads. Sometimes they're right on the dot. If we do keep seeing the US 10-year, 20-year, and 30-year drop off, and we've already seen what we call a first time frame change of trend, or one of the first closes that shows us that it might be over for the rate hikes coming through, then yeah, it could be very soon when we see the Fed actually go for the rate cut. It may be actually Q1 of 2024, which is, of course, my random estimation, which means absolutely nothing, just like all of our other guesses that were in there. Some of you thought you were with Goldman Sachs end of next year. Some of you were Q2, some were Q1, some were Q3. At the end of the day, guessing when the rate cut comes, that's not really going to help us that much. What we're interested in is what does it mean if they do a rate cut? Well, generally, if the Fed rate cuts, something bad happens. So remember, if the Fed rate cuts, something broke, and they're trying to support the companies and the country. Generally speaking, they don't do it out of their goodness of their heart. In fact, when they went from a previous hike cycle to a cut cycle, we actually saw markets go down on average quite a lot, 23.5% and 195 days average to the low. Now, I'm not saying it's going to be this bad. I don't know that. Neither do you. It may be worse. It may be better. It could be like 1980 where it never even went down. But what we're trying to say here is that we don't really necessarily need to be concerned before it happens. It's the concern after. And that's what we've been getting through recently when we've been going through the statistics and the general play that happens through the end of this year, which is, of course, usually a rally that may stop early in 2024. Let's go through gold. This one was really finding some big drivers towards the upward side. We also saw gold with a squeeze on it the other day. Same stats we've been putting in every video, so I won't talk about that too much. Here's another interesting one that shows you when we've seen similar times where we've had basically a market that was bullish throughout the year, which 2023 has been. Then usually November 15th to December 31 was positive, and we actually had 27-3 in terms of the bullish times through that. A pretty good stat if you are a bull. 30-year bond yield performance between November 26 and 26 was usually negative, which of course was helping treasuries. So far, so good for that. An interesting stat that happens, well, pretty much every single year. Let's go over here to November. What's going on with market performance at this stage? It's been a little bit better than this year. Of course, you're going to say, well, it's only 1% here, but we've done a lot more than that. So I would say it kind of looks like this at this stage. Now, if it's going to pull back, when does it tend to do so? The bigger pullback usually happens the week after the OPEX. So the OPEX is the trillions of dollars of options expiration. That's happening this Friday. Then we would usually see a bit of weakness coming through the next week. Then we would see strength. Will we get the pullback then? The markets are starting to signal that that's a real possibility. And obviously we'll need to look for structure very, very soon. Let's move through some of the dark pool or big transactions. We had some inverse gold, big trade coming through. Obviously, gold was really doing well last 24 hours. It absolutely smashed it, which was pretty sweet. And we saw also gold miners finding some larger investment sizes. So you can see here, recently, gold miners have had quite a lot of large trades come through out of nowhere. It's any of the gold stocks have had quite a lot of big dark pool buying or big dark pool positioning. This is another one we showed, which was the dollar having a massive position in it out of nowhere. We kind of theorized that maybe the dollar was weakening on the charts. And well, it certainly got helped by CPI. The market set up, the market showed the structure, but really the CPI did the damage on that one. It was just all of it was kind of like coiling for these particular moves. And it turns out that they were quite large. Let's go over to average options volumes and what was happening here. Well, of course, every single one of these stocks was green. However, the trades that really made a big difference here is, have a look at this. 57% of the session was calls, 43% puts. So obviously the puts are dying off as we move up to this big critical level. 47.2 million volume compared to 39.7. So that's a huge, huge average day. This is way above any average day that we usually see. And there were big moves across the board. The Russell 2000 getting a lot of activity on it, of course. But more importantly than that, we saw activity across so many different stocks. And you'll notice here all the unusual volumes coming through and some of these big ones. Tesla doing a 1.18, having 1.5 million call volume to put volume. And we also had some big trades coming through, things like the Microsoft and even, the Qs and everything else. So yeah, check it out. Pause this screen if you're interested. I think solar was probably the most interesting one. Enphase in particular, what a chart that ended up being. I had that in our Market Masters Club and I was talking about it and I was like, yeah, I'm going to set an alert for this. But unfortunately for me being Australian, by the time the market opened, it was about 1 something a.m. and the trigger went off a little bit late for me. So that was a crazy day. It went up like 15% or something on the session. Let's move over here to rotation. What goes on was solar, 10% up across all of TAN. Clean energy doing very well. KRE, regional banks coming back strong. Look at home builders. Wow, that's a strong read for those. We also had some of my favorites at the moment. Metals, iron ore having a great session. Gold having a great session. Utilities having a great session. I mean, if you wanted to say what was doing well, it was a lot of the semi-underloved things that retail don't tend to be in as much, except for the hyper-growth stocks. They were certainly going crazy. But semiconductors only did 3 in comparison to everything else. Notice the defensives down here and also energy. Energy having a pretty bad session. It doesn't really like, of course, a slowing inflation read, and that's what we saw there. Let's move over to some others that have been happening the last 5 days. Notably, I think IBB Biotechs, which should really do quite a lot better off a lowering interest rate. That was actually the worst performing of the major sectors over the last 5 days. Could there be opportunity there? Certainly worthwhile considering on a chart in terms of whether we're getting some structure there. We also see semiconductors and home builders up in the top. And now in 1 day, TAN went from like one of the worst to one of the best, up 4.83%. It was just massive across the board. Let's jump into the charts now and have a look at the advanced decline and, of course, the key levels we should be watching. First up, advanced decline was massive, 2309. So we saw a huge read, big high. This is an outlier kind of in terms of advances. Here are some of the similar reads we've had November of 2022. And we also got a read back here in May of 2022. We haven't seen such a strong read for a while, though. So this is pretty serious for thrust, for breadth, all of those types of things. No change on our orange indicator that we're talking about in terms of effective yield. So that means even though it dropped down here a little bit, which is fine for the move. So overall, no early warning signs there. And PCC dropped right back down. So rather than having a decent amount of puts in the system, we dropped into the call side, which usually means that we need to start thinking about, question mark, are we at a key resistance? Do we see structural change? Are we ready for a pullback? We're probably getting extended at this stage. Well, it's probably not even probably. We are getting extended at this stage. In terms of the percentage of stocks above the 20 moving average, it was a huge session going up to 76% of all stocks. Just to show you that above 200, that is absolutely done a V shape, showing that this is more than likely a real recovery. Of course, we saw that sign over here when we breached through this area here, which was Thursday, 2nd of November. It's always pays to have a look at the percentage of stocks above, because of course we are interested in whether companies across the board are recovering, not just necessarily the Magnificent Seven. Let's go to the Move Bond Yield Index here. It's jumping up to 124. The VIX actually dropped off to 14. And I think there's some stats with the VIX that we'll bring in the next video, because the VIX has been dropping considerably each session. And this is something that's actually quite rare, and it does have some stats around it. So we'll bring that up in the next session if we can compile the stats for you. Let's move over to US 2-year yields. They dropped like a rock from the supply. This was the zone we want to set alerts for, and straight back down to the low here. Interestingly, no new lows. They managed to actually just find this, and I'm sure there'll be like some kind of pickup from that point. Maybe it'll take a while to get through. US 10-year did drop to a new low, so that's certainly something we're watching. And if you go to the US 20Y, 30Y, etc., you'll notice all of them were just placing in new lows. So for now, the alert should be set above here if you are feeling bearish, because of course, if the markets get back above that, that's going to be certainly a cause for concern for, I think, all bulls out there, and the bears are going to be pretty happy. But at this stage, bulls will be liking what they see in terms of yield drops across the board, at least temporarily. That could support the markets. Treasuries had a good session, up 2.27, breaking to a new high, kind of looking for those gap fills up to like 93 or so. Treasuries looking like they may have put in their lows. High yield junk doing really well. Corporates doing really well. Again, just across the board, bonds recovering. And this is the big breakout star, the equal weight S&P 500. A really nice session for this. Absolutely smashing through these, showing that, again, pullbacks are more than likely going to be met by bull demand based on the current technicals that we're seeing. And again, a huge amount of volume going through on these charts. The S&P 500 continued to see injections from both the Fed, which is the green line, and also central banks around the world. Though I would note that central banks around the world seem to inject more. I still think something's broken in the system, but again, that doesn't mean that the markets are going to crash straight away. It just means that it's broken, so they're injecting secretly in the back using all the tools. That's what Jerome always says, isn't it? Dow Jones Transportation Average, one of our lead indicators, absolutely destroying any bears there, just pushing straight through. Home builders, I mean, this thing's almost on a new high. I mean, that is a phenomenal move from home builders. Again, showing us potentially real strength here in the markets. Yeah, that's a big move. You can tell that I'm like, whoa, these beams were big, because they really were. Like, to see the Russell do 5, I didn't think it was going to do 5 in one day. I mean, if you did, cool, congratulations. But I thought it would just go up like 1 or 2, not 5. So there you go. It was a large move. Copper, where you see that holding that trend line. Of course, that's what we're looking at along with iron ore, which has been breaking out. So remember, check out your iron ore and make sure you look at the continuous contract, because that's absolutely breaking to new highs here. And it can show you that maybe things aren't all that they seem. Everyone's saying everything's horrible, but iron ore is doing really well, which usually shows construction and a few other things are in play. Let's move over to the dollar. So this is where things really turn to the negative side. And the dollar is basically saying, you know what, the top's in. Now, could it not be? It's possible, but we've been speculating for a while. We went neutral bearish on it up here. It was a critical level. We obviously like the short time frame sells in this zone. And if you were, fortune favors the brave in this one. That was certainly a huge move. Another notable that we brought up earlier on this week, if you've been watching, was, of course, the Australian dollar. And I can tell you I was pretty happy with that one. That was a thing of beauty. That moved quite a lot. We ended up going up almost 130, 40 pips. So it was an absolutely massive move. And if you want to go back through our videos, you'll see that we were speaking about that one. Gold was also an absolute standout, coming off our serious level of demand and then smashing straight into that supply side. I'm not sure if it will stop here. Obviously, that's a very strong move for it. And I do think this supply is a little bit of a critical zone. But let's say we breach that a little bit and then we pull back. Of course, I do think pullbacks will be met by bull demand at this point on gold. Yields will be all important to look at for this particular metal. But GDX was probably the standout for gold. So if you have a look at GDX, we've been talking about the underperformance of the stocks. island reversal off the bottom here. Again, pullbacks may happen straight away on gold, but realistically, it's all showing bullish intentions on the price action. Let's move over to US oil. So US oil should have performed pretty poorly based on the fact that we had that drop off in yields and we had the drop off in inflation. It did find some problems at the first level, which is this supply, though it still held up really well. It actually managed to hold pretty damn clear. I'm wondering whether we can still get up to 81.50 to 82 on the supply side for oil. I'm going to hold short-term bullish here, although that wasn't great, that little candle breakdown. I think it's short-term bullish still on oil, and we'll find out whether it can go up. That doesn't mean oil stocks, though. I just think it's a little bit of spot kind of catching back up to the daily 20 moving average, of which it's quite far away from. And you will see that there's this big rejection wick, but I'm not convinced just by a rejection wick itself. Tesla, that was really beautiful in terms of the move. I would like to see a little bit extra to fill the gap, which is at 241. I don't know if it's worth reversing it straight away, but certainly a very nice move here. In 2 days, 10%. You can't really ask for much more than that. And we've been speaking about it on the channel. So that was pretty nice. So, of course, price action showing the way in this case before, but of course, getting very lucky with the CPI number. The key here is always to think, well, did you get lucky? Maybe. I mean, obviously, you've potentially produced a good chart and you've said, okay, I found the what position it's going in, but it very could have gone like a bad number, and you've got to be careful about getting too much ahead of yourself. XLF did have a nice session, but I think the standout for the session was probably XLU in terms of the random sectors. This one was just flying higher. Another one that's interesting is IBB Biotechs. They pushed back up. They're obviously incredibly beaten down. So this could be a sector that may get rotation into it. We'll be looking at it on our daily show as much as we can just to see whether it does have rotation. The Australian market did well, breaking to a new high, showing us that those two bullish wicks were really showing the good stuff. And at this stage, we could see again a possibility of pullbacks here. But I do think that the Russell 2000 and S&P 500 hold the key. Here's the CQQQ, which is the Chinese market, having a good session, 2.34%. No breakout yet, though, so really no triggers there. And look at this, it's off the charts. So we had really small time frames showing us that maybe the Russell was gearing into a bit of a buy, but it's pressuring this 1810, 1800 level. At the time of this recording, we're actually getting right into that critical supply zone. Now, this is all very good and all very bullish, but this is where I could expect potentially sellers or structural TP and all of sorts of things going on. So we'll have to actually wait now to see the setups potentially occur, but this is certainly a very green level for markets. And this is exactly where we expected the market to potentially go if it was going bullish, and where it might find some troubles. Now, if it just blitzes this and it keeps going up, that would mean the S&P 500 is going to blitz a key zone. So Russell right into the critical area, the first one anyway. The Qs right at the highs. So you'll notice here that if we have a look at the NASDAQ, it's just sitting on its highs for the weekly here. This is a huge level. I'm not sure if it'll hold it. We'll look at max pain in just a few moments. But yeah, it looks like a breakout is going to come. Whether we get a pullback first is the question. There's the NASDAQ on the futures pushing even higher. Let's have a look at the SPX now and bring that onto the chart. So the S&P 500 coming into our red box zone here. We had 45.12 being one of our critical levels. And of course, the real market managed to get about a 45.06. Big break, massive move. Obviously did a lot of it in the pre-market session. Gaps galore. So we now have one. Well, we even have more. It's like a 1, 2, 3, 4. I guess that's 5, 6 gaps. So we've got 6 gaps coming up. That's a lot of fill that could happen. And I'm kind of speculating that this is a real possibility. Here is where I expect the danger zone, but we don't know yet. It's more of a guess if you're going against it at this stage. It's melting up. It's pressing those stats. We're looking for, do we get a change of structure up in here? And we're going to have to be patient for that if you are a bear and react to the market structure and not necessarily predict it. If you predict it, maybe an option is the best way to go. But yeah, that's there. So you can see we've got a lot of green squiggly lines down here. We'll call them green squiggly lines. We've obviously got the trend line down here. We've got market structure down here. So there's a lot to like about a pullback down into this 43 kind of 100 level, 42.90, 42.80, that area down there. We've got green box in here, of course, as well, that we're expecting could happen in the future. We're looking for structure. We've got absolutely none at this point, but I could see some people trying to take some profit over the next 24 hours. Big move, lots of profit to be taken off the table from some of the buyers. Let's move over to Bitcoin here as we approach into a different market. So Bitcoin acted a little bit like the dollar. It really didn't like it. Now, I usually say don't short a dull market. So it was dull, then it kind of like rallied up. Now, a few of you did mention you were short up in here. I'm not convinced that Bitcoin's going to get absolutely smashed yet. Unfortunately, for bulls or bears, it didn't actually push below any key levels like these low zones down here. So I still think it could rally back up. And I guess we just have to maintain that this rally at this stage is possible to go to 39.5 or even 46K until proven otherwise. So it was a pretty nasty session. It was due to Ethereum. So if you did short based on Ethereum and not Bitcoin, that wouldn't be too bad. And you can tell why Ethereum, because it was absolutely hitting into that 21.22, which is an excellent resistance zone. So I think it was more Ethereum than Bitcoin's price action. And that's why it pays to look at those top two. And it's kind of like looking at the NASDAQ or the Russell 2000 and the S&P. Sometimes you'll see a little bit of information on one of the others and it can help you out. Let's move over to maximum pain and where that's all sitting this week. So let's refresh this and we'll have a look. And we can see here there's some big options changes. So first up, we got 430 puts getting stacked on stacked on stacked. Let's just refresh this and make sure it's actually correct. We do want to always set for the 17th. You can always tell an OPEX, by the way, because you'll see this big open interest amount, which actually has dropped over the last 24 hours. So a few options are being closed. Now, we do have a 440 strike call wall. So that means that it would be better for the market to probably actually sell a little bit coming into the Friday. Usually the Thursday is the most volatile day, but with retail sales coming, so retail sales is the next big event, then we usually will get a fairly large move off that. Could we pressure back into this 430, 440 range? It seems plausible, and I think quite likely that that's where we'll try to get to. So keep watching the maximum pain. At this stage, 431's max pain. Doesn't matter so much about that number. We're interested where all of these puts and calls lie. When there's trillions of dollars at stake, it does make a difference. Do remember, over the next 24 hours, we have more news coming. We've got core retail sales. We've got PPI coming, 8:30 a.m. New York time. Then we scroll through. This is the rest of the week in terms of the rest of the news. But we do have the trillions of dollars of options expiration. If you're interested in finding out a little bit more about what we do and, of course, some of the things we do, I would recommend going and checking out our VIP free weekly newsletter that we've just launched. So definitely get into that, limited offers. And, of course, of spaces that we're doing because we're just launching it as a bit of a beta. And then, of course, we also have our normal competition for the month if you're interested, and follow us on any of the random socials that we do, etc., etc. Thanks so much for watching, guys. If you enjoyed today's video, make sure to subscribe, smash that alert button, and I hope you had a good last 24 hours. If you didn't, don't worry. You know, it's time to basically, you have to kind of like shake it off and we have to go to the next session. But it's always about trying to interpret these markets. They were certainly very difficult, and really it only became clear after Friday, where it did a bit of a burner on the sells, that this thing wanted to go higher. And that's where we got that 45.12, 45.20 kind of zone on the S&P. So it's tough out there, guys, but that's trading for you. And sometimes you're going to be in the right side and sometimes you won't. And hopefully you get on the right side soon. Thank you so much. Bye for now.